Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on Nasdaq. The NDX has been the barometer for U.S. large-cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining me this Wednesday afternoon, we have Ryan McCormack, factor and core equity strategist at Invesco, to discuss Nasdaq-100 weekly performance. We'll also take a look at some consumer data. And Ryan, it's interesting that the past week of the Nasdaq-100, in fact, all the indexes has been quite stunning, the rally, and then seeing a little bit of that reversal.
Yeah, it's sort of like a tale of 2 weeks, right? So, all things told, QQQ and QQQM were up 78 and 79 basis points respectively. That's relative to the S&P 500, up just over 1.5%, and S&P 500 value up 1.72%. Growth had been leading into last weekend after sort of risk-on trading sessions that we saw on Thursday and Friday. QQQ alone traded higher by 3.4% on Friday, and we've sort of seen this where investors are picking at some of the growth-oriented names and sectors that had been beaten up thus far this year. But then we saw Monday and yesterday brought kind of widespread sell-off driven again by this recessionary fear. S&P 500, S&P 500 value were just down less than Nasdaq 100. And that was driven by the Conference Board's consumer confidence index fell for the month of June. We saw revisions from economists on broad-based growth, as well as reductions in earnings estimates for a couple of growth-oriented sectors. So risk was certainly off yesterday.
And Ryan, if we take a look at the sectors, where was the performance?
Yeah, so on a relative basis, the lack of energy and materials in QQQ helped this week. We saw those two sectors in the red. Overweights to technology and communication services also helped on a relative basis, but the overweight to discretionary hurt QQQ relative performance. The sector traded lower by just over 1%, as well as some of the more value-oriented sectors that outperformed within the S&P.
And Ryan, let's go back to the consumer data for a moment. We know how important the consumer has been to the recovery since the pandemic and kind of keeping the economy in check right now. Of course, 70% GDP. It appears that it's slowing, but still kind of growing the economy overall. What does the consumer data say?
Yeah, so there's a lot of data to digest, and this morning we saw a revised lower 1.6% contraction for the third and final reading of Q1 GDP, and the consumption data it grew at the slowest level since June of 2020, kind of peak pandemic. It rose by only 1.8%, but this compares to a 3.1% reading in the previous estimate. That's a pretty big revision for the third estimate of GDP. Within that, they revised lower spending on both services and merchandise. We also saw inventories revised higher. And this kind of all goes together with data last week that saw gasoline purchases fell. We've seen plunging consumer confidence, not only from the Conference Board reading, but also University of Michigan. It could be the consumers tightening the fiscal belts. Although the one bright spot was last week during University of Michigan, the confidence reading, long-term inflation estimates fell to 3.1%, down from 3.3. So you're sort of seeing this, and recall, right? GDP is backward looking. These are readings for Q1. Tomorrow I think we're going to start to continue to see readings for where we are at this current stage of the economic cycle. We get a view into the employment picture, which has been an area of strength. We're starting to see, though, initial jobless claims tick higher. The week ended March 18th represented the lowest level at 166,000. Estimates for the week ended June 25th, which will be released tomorrow, is around 229,000, roughly in line with the previous two readings. Tomorrow, we're also going to see the PCE deflator, the Fed's preferred inflation gauge, expected to tick up to 6.1%. The core reading is expected to drop by 0.1% to 4.8%. And then Friday, we get ISM manufacturing PMI, which is still firmly above 50, right? That's that line between expansion and contraction, although we've seen this reading trending lower since the second half of last year. So the next 2 days should give us some pretty decent insight into the current state of the economy, and whether this trend of consumers tightening their fiscal belt on the back of inflation worries and expected slower economic growth is to be trusted. a lot to keep an eye on ahead of the holiday weekend.
Yes, certainly the holiday weekend. A little bit of a break for all of us here. Ryan, great to see you. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.